Bring in Alexandra Wilson-Elizondo. Excuse me. I'm having a problem this morning.
Let's get hooked on phonics.
He's hooked on
Elizondo. Elizondo.
She's the co-chief investment officer. It's like I was hiccuping. Multi-asset solutions at Goldman Sachs Asset Management.
Well, you drink so much coffee. I mean, what? You drink so much coffee.
It doesn't matter what you're drinking.
How many cups of coffee? I mean, we have a lot of viewers out there.
One in the morning.
How many cups of coffee do you drink?
One.
Not big.
1 cup.
In the morning.
And then 1 in the afternoon?
Instead of the glucose you're worried about, worry about too much caffeine.
I do 2 cups of coffee.
Okay, I've seen more. Some mornings it's more. You say, well, bring me another plate.
Well, sometimes it's very tiring because this is very complicated stuff.
He blames me.
He pointed at him when you said very tiring.
I know.
Yes, exactly. Anyway, it's very nice to see you.
Nice to see you too.
Okay, so we're all trying to figure out what to do in this crazy market. What are you doing?
I think the most important thing for us is direction of travel. And
what does that mean?
The global cutting cycle is here. It has been delayed, but that just means that, this should be very positive for risk assets. Now, there's a huge but in there, which is it's not just like buy length in your portfolio and beta and hope for, the best outcome. In fact, we've seen like very differentiated outcomes in the month of January amongst active managers for the recent period, the first time. So since 2007, it's been the best month for active management. And you
think that continues, or do you think that's a weird fluke?
No, we really do think it continues. I think the market is going to reward fundamental analysis and being a little bit more agile in terms of, relative value, and then paying attention to when the market gets a little bit too extreme and in front of itself, and being thoughtful about, not timing it, but paring back risk.
I'm going to make a presumption that a lot of our audience just owns the S&P. They might own the Russell. They might own the Dow. Do you think that's a bad idea?
No, I don't think it's a bad idea at all. In fact, I think the biggest question is this a bubble, right? And I'm going to burst the bubble and say that we really view this as being a scale game, right? The market is rewarding scale players. And if you look at it, there's about 30% of the market. They're also 30% of organic investment. I mean, that means that they're really driving a lot of what's happening in the U.S. economy. And that's a place to be.
How much of this sort of is a virtuous cycle in that, if you're a manager, your index is the S&P 500, so you've got to be in these names. And so there's this sort of money flow situation where you've got to be in them no matter how painful the valuations you may think they are, or you don't want to be in that part of the market, but you have to be in order to meet your performance targets.
So I think last year you could make that argument, right? It was very difficult, and you saw that for active management, but you did see material differentiation in the beginning of this year and even in the earnings the first quarter. So I think it's really starting to say we're moving away from like the market just trades the theme to like there's real fundamental differentiation amongst these names.
And how much of the AI halo, do you think, on a percentage basis, you think is in the averages right now? And I'm not saying it's wrong, because I remember when the internet definitely in '99 was having a positive effect on on the averages. But in hindsight, how much of our current world is internet? I mean, 50% of the gains in innovation we've seen are internet. So it was worth it. Is AI going to live up to that?
I mean, I think when you even look at some of the most recent names that are reporting, and then their forward guidance is showing that there's even more conviction there.
But should the S&P be up an additional 10, 15% because of AI?
I think
is it?
It's not really. So when you lift the hood and you look at valuations just in terms of PEs, the average stock looks about average for where you should be in this type of cycle. So we don't really think that that's the case. But to your point, sentiment and positioning right now aren't necessarily tailwinds, right? So the market is, I would say that the market is very happy. People are invested. And so you need to be thoughtful about, what trader parlance would call buy the dip and sell the rip, if you will.
We've had a whole bunch of people come on in the last 2 weeks specifically and say, look, we're in a presidential election year. It's just going to get complicated this fall and maybe a bad situation. What do you think?
I mean, I wouldn't necessarily say it's a bad situation, but I do think we're going to start looking through the Fed being the only game in town to now you're going to see some vol in the equity market where it's only really been in rates. when you start to see what the policies are going to be that are put forward. Any of the trade rhetoric picking back up, you're going to see certain sectors trade better than others.